Good morning and welcome back to our 10th annual Financial Executive Forum. This is the fifth event in our 2024 webinar series, and we really appreciate all of you joining us this morning. My name is Grant Palmer, and I'm a partner with Cordia Resources by Cherry Beckert, one of the sponsors of this series. And as you'll see, we also have four other great local sponsors who I'll introduce shortly. I also want to thank and acknowledge Marsh McLennan for the excellent program last week on managing your risk, innovation in employee benefits and business insurance, as presented by Ali Gregory, Gerald Escobar, Mike Cooper, and the Marsh McLennan team. Our sponsors have been excited to see such a great response with nearly 650 people registered for this series. We know and understand how valuable these high quality and relevant training events are to financial professionals managing corporate accounting and financial functions. Once again, we're providing this series in a fully virtual format and are running it in 2-hour sessions every Thursday morning over a 6-week period of time. We found that this format works best for our collective clients and friends. Today, we're joined by Ben Kane, Tim Quinlan, Chris O'Gean, Nida Zaman, and John Hand from Wells Fargo Bank, who will be presenting their economic outlook and capital markets update, plus a special and timely presentation on the 2024 election outlook. You should also know that we have a great team running our virtual program today, but please bear with us should there be any technical issues. As you can see, we have 6 great programs for you in this year's series. If you fully attend all 6 events and you're a CPA, you can earn a total of up to 12 full CPE credits. Last week, Marsh McLennan, a new sponsor to the FEF, presented Managing Your Risk, Innovation in Employee Benefits and Business Insurance. Today, the Wells Fargo banking team will present their economic outlook and capital markets update, plus a special 2024 election outlook. And finally, we'll wrap up the series next week, November 7th, with Sage, also a new sponsor to the Financial Executive Forum, and they will present how AI and digital networks will shape the future of accounting. Before we move forward, I'd like to cover some of our basic CPE webinar rules. In terms of NASBA compliance, our polling questions will appear throughout the webinar. You will need to answer 75% of the 8 polling questions to receive full CPE credit for each session. Any answer to a polling question, correct or incorrect, counts towards the 75%. Since you'll be muted during the entire session, please use the Q&A feature to submit your questions to the panelists. Also, please use the chat feature to communicate any technical issues that you may have. After the program, please complete the session survey using the link that we'll send to you in the post-event email. Your CPE certificate should be issued within 10 days, if not sooner, of this course. If you have any questions, please reach out to Cherry Beckert Learning at cbhlearning@cbh.com. Now I'd like to acknowledge and introduce our great team of sponsors for this entire 2024 Financial Executive Forum series. First up is Michael Cooper, a consultant at Marsh McLennan Agency, a new sponsor this year, and we're very happy to have them as part of the Financial Executive Forum. Mike, welcome.
Yeah, thanks, Grant. Appreciate it. Good morning, everybody, and happy Halloween. So my name is Michael Cooper. If you didn't join us last week for our session on managing risk, both benefits and business insurance. If you're not familiar, Marsh McLennan Agency is a leader in the middle market insurance brokering and consulting business. We are lucky enough to be backed by the world's largest agency in this area, Marsh McLennan. So our job really at the end of the day is to bring those resources that they provide at an enterprise level to companies just like you. So we work exclusively in the middle market, call it anywhere from 50 employees all the way to 5,000. And our team around DC and Nova, Southern Maryland, would love to chat with you. And if you're curious about last week, if you missed a session, we'd love to have the slides or anything else, feel free to reach out. But thanks for joining and looking forward to it. Thanks, Grant.
Thanks, Mike. And it was a great program last week. Really appreciate it. Next up is Gary Marr, Senior Channel Executive at Sage. Sage is also a new sponsor to this year's FEF, and we're very excited to have them as part of the series. Gary, you're up.
Thank you. Glad to be here. Hey, I'm Gary Marr. I'm a Senior Channel Manager with Sage. For those not familiar with Sage, we are a market leader for integrated accounting, payroll, and payment systems worldwide. We have millions of customers worldwide. Our leading product is Sage Intacct, and Sage Intacct is a true cloud solution It is very focused. In fact, Sage is entirely focused on the accounting and financial industry. We don't have a lot of products in other industries or operating systems, things such as that. We focus entirely on the financial industry, on the needs of accountants and finance professionals. Very significantly, we are the only preferred provider of the AI CPA. And for years running now, we've been #1 from G2 in terms of customer satisfaction, which is something that we are very, very proud of, and it's pretty significant. Next week, our CTO, Aaron Harris, is going to be talking to you about AI and how that affects accounting. I've sat through many of his presentations, and I think you guys will find that extremely interesting and valuable.
Thank you, Gary, and we look forward to next week's program for sure. Third is Tracy Sheps, a CPA and a partner with Cherry Beckert. Cherry Beckert is a returning sponsor to this year's Financial Executive Forum. Tracy, you're up.
Good morning. Just wanted to say a little bit about Cherry Beckert. We're a full service firm, and we provide from core audit and tax to strategic advisory, including transactional, digital, and strategic business solutions. Our comprehensive outsourced managed solutions fit specific business needs and provide industry-focused expertise in government contracting, nonprofit, and a full breadth of commercial industries. Our significant expertise in government contracting provides our clients with full service accounting support, compliance excellence, and best-in-class accounting systems. Whether you're an experienced government contractor or just starting to venture into government work, we have the appropriate solution to ensure you are audit ready at all times. Our best-in-class software, we utilize Deltek CostPoint, Uninet GovCon, and Sage Intacct based on individual company needs. With our recent acquisition of Kerr Consulting, this aligns with our firm's industry-focused vision and will provide our clients with the entire Sage suite of solutions and services. Be sure to join us next Thursday for an exciting Sage presentation, how AI and digital networks will shape the future of accounting. And thanks for joining us.
Thank you, Tracy. Appreciate that. Next up, Cordia Resources by Cherry Beckert. Doug Smith, one of our managing directors, is not able to attend today, but we're happy to have Evan Seward, Executive Search Director with our Cordia Resources practice. As you may know, Cordia Resources is one of the original founders of this FEF series. Evan, over to you.
Yeah, hey everyone, good morning and happy Halloween. I don't know who's about to have more fun. My kid's eating breakfast upstairs, probably candy for breakfast and probably for dinner as well, or I was about to listen to Tim here this morning, give a state on the economy. As Grant mentioned, my name's Evan Seward. I'm an executive search director here at Cordia. We provide recruiting and staffing workforce solutions in the fields of accounting, finance, HR, IT, contract administration, pricing, and more. We've always taken pride in our deep roots in the accounting field. We've happily celebrated, if you all weren't aware, our 1-year anniversary with Cherry Beckert, as Tracy lightly mentioned, and Cordia is now a unique service line within Cherry Beckert's advisory practice. We're fully capable of assisting organizations of really all types and sizes across many industries in the DC area and across the US with direct hire and interim staffing recruiting needs. If your team if you find yourself in the need of recruiting or staffing support, we're here to help. Enjoy the session and happy Halloween.
Thanks, Evan. Finally is Ben Kane, a Senior Market Director at Wells Fargo Bank. Wells Fargo is a returning and longtime sponsor and supporter of the Financial Executive Forum. Ben will also lead us into today's presentation. Ben, you're up.
Thanks, Grant. Appreciate it. As Grant mentioned, I think this is year 8. Joe and I were trying to figure that out, and neither of our memories are good enough anymore to figure out if it's year 7 or 8. But we're thrilled to again be a part of this. One of our major goals here at Wells in commercial banking is to provide valuable content, ideas, data to our clients and our prospective clients. And we think that the CPE/Financial Executive Forum is one of the best venues to do that. So I'll just kind of jump into what we're doing today. We think it's going to be kind of a timely and relevant morning. So first, we're going to kick off with Tim Quinlan, who is our senior economist here with Wells Fargo. Tim's been to this market for probably 10 plus years. He's been coming. So I think he's done the last 5 years here virtually. on the Financial Executive Forum. So we're super excited for that. Always good content. Then we're going to have our local, or excuse me, our regional investment banker, Chris O'Gene, is going to give us a capital markets update. So debt, equity markets, M&A. And then lastly, kind of a late addition to some extent, we've decided to go ahead and have a couple of our government relations folks do an economic outlook, kind of what we're expecting, what maybe some surprises are, et cetera, for the coming election, both at kind of a congressional, Senate, and presidential level. So, and then we'll kick it back to Grant to kind of wrap us up for this week's session. So, as you can see, we've got 4 really great speakers. Like I said, we're going to kick off with Tim here in just a moment. I didn't say it. My name is Ben Kane. I'm with Wells Fargo's Commercial Banking. I want you to do me a favor real quick. Write down my email. We're going to try and make this somewhat fun today. Tim's always a lot of fun, but we're gonna kind of make it a little more interactive. So my email address is ben.kane@wellsfargo.com. It's ben.kane@wellsfargo.com. If you guys have heard Tim in the past, he is awesome at like slipping in pop culture kind of references, whether it be musical or movies or celebrity or whatever, something. And he's going to do so hopefully today at least a couple of times without giving you what the actual reference is. And so if you hear one of his pop culture things, I'll click one of the little emoji things at the bottom. If you see that, please email my email address as I just gave you with the answer. And we're going to give away like some kind of fun banker fun stuff. Everyone that knows me knows I like to have fun. So we'll give away some fun things, that whether it be related to sports or wine or what have you. So there's kind of a grab all. But anyways, again, ben.kane@Wells Fargo. Email me if you know what Tim's kind of references are. So with that, we'll jump right into Tim. Tim's, like I said, been just a really great advocate for our local team. He's been, like I said, in person for the past decade, loves doing this type of content. One of the biggest things about this, Tim learns as much from this via our questions as kind of we learn from him. And this informs his future presentation. So use that Q&A thing at the bottom for any sort of questions you may have. And I'll kind of moderate those as we go through and try and make them, kind of really relevant to what he's talking about at the moment, as opposed to tons of questions at the end. So please answer those. And then as a reminder, you'll have a bunch of participation type of things throughout that. And we'll try to make sure we remind you of that. So with that, Tim, I'll let you get cracking here, and appreciate everyone for joining, and hope you enjoy the presentation.
Well, thanks everybody for joining us for this. We've already had our first question from Evan. Who's going to have more fun, his kids eating candy for breakfast or us? Evan, sorry, you're definitely your kids. We'll make this as much fun as we can, but I don't think I can match the fun of having candy bars for breakfast. We do have some great content, and this thing about pop culture references, this was something Ben texted me like 5 minutes ago. So I don't have like a bunch of them lined up. This is going to be pure improv. So I hope you guys are, I hope I'm able to come up with some content that I think people are going to find worthwhile. In lieu of all of that, I'll just get started here. And all right, so we'll kick off with kind of this view of GDP. And this does not reflect yesterday's numbers. I have to get my slide deck cleared through compliance and stuff. So things are up to about Thursday of last week. So there are a couple things where we've gotten new data, and there will be a key piece of data breaking in about 14 minutes at 8:30 with the latest personal income and spending numbers. But in short, third quarter GDP growth came in more or less the same as this. I think it was 2.8% at an annualized rate for the third quarter. So, the composition of it was consumer spending continuing to kind of drive things, and had a little bit of a drag from inventories and a little bit of a drag from net exports. And that kind of happens when you have strong consumer or strong business fixed investment spending. There's a little bit of a counterweight where you get a drag from imports, because a lot of consumer goods spending anyway reflects a pull forward of imports. If that's not matched with exports on the other side of it, then you get a drag from the trade component here. But in short, decent numbers here for the overall economy. And that's kind of weird, right? I think when we did this thing last year, we talked about how it's going to be a close call between a soft landing and a mild recession. And when we talk about some components of economic growth, like manufacturing and industrial production, I think there's a rather compelling case to be made that things still feel a little bit close to recession. But to look at these GDP numbers, I mean, give me a break. There's nothing in that looks recessionary at all. And that comes despite the fact that a lot of key recession warning indicators, from the leading economic index, which has been flat or negative in 31 months in a row, that's 2.5 years. It's actually 1 month more than 2.5 years that kind of bellwether has been negative. The ISM manufacturing index certainly has been. Joe and I were talking before the start of the call about the inverted yield curve, which is no longer inverted. It's back to normal, not normal-ish, where longer dated bonds have a higher yield than shorter dated ones. But for more than 2 years, that was not the case. So that's a traditional recession indicator, and they've not really blown up. The latest one to have gone off is the SOM recession rule. If you're not familiar with this one, it just says if the unemployment rate is rising quickly or in full, I mean, we're forgetting CPE credit here. Let's go full definition. If the 3-month moving average of the U3 unemployment rate, that's conventionally just the regular unemployment rate, if that measure rises more than 0.5 percentage point above its prior low in the past 12 months, then you're in recession. And so when you kind of look at this, and hopefully you can see my mouse arrow as I point at some of this stuff, but there's 2 sets of recession bars. These are the SOM recession indicator warnings on top, and then the bottom is the official NBER dates. And the point of this is to say that, well, it may not be a particularly forward-looking gauge or leading indicator of recession. It's a pretty darn reliable one. It's not missed a recession since John F. Kennedy was in the White House. So, pretty reliable gauge here. And this one has, in 2 out of the past 3 months, this has been signaling recession again. And that kind of highlights the, shall we say, newfound urgency among policymakers at the Federal Reserve to, begin their rate lowering campaign with a big bite of the apple with a 50 basis point cut in September. That doesn't oblige them to further 50 basis point cuts. And we should point out that through September, it's no longer in that threshold range. We'll see what happens with the jobs report for October. But in short, this is the latest indicator to suggest that some risk of recession out there. And I think I'm not particularly worried about it. The Claudia Sahm is the economist who this is named after. She herself has said she doesn't think that it's giving a true signal this time for a few reasons. One is we started with a very, very low level on the unemployment rate at the start of the year. And secondly, we've had a lot of new entrants into the labor force. But I think when you look at kind of the overall, the jobs report or non-farm payroll growth, it's, yes, it's kind of a trend down. This period in 2021 and 2022 is your kind of rebound from all the layoffs during the pandemic. But really, since the start of 2023, it's been pretty stable there. The red line gives you a 6-month moving average. And I suppose you could argue that there's a modest trend downward there. But, in the past 4 months or so, the trend has been, kind of rebounding a little bit. 1 month does not a trend make, as we often say in the world of econ. And I think what the broader reaction I've got to the SOM recession rule and this newfound urgency with policymakers at the Fed is that the labor market is finally, or I should say that the jobs report itself is finally corroborating the weakness that we've seen in the labor market in so many other indicators. And when I say that, I mean things like temporary unemployment, where the year-over-year change in the hiring of temporary workers is often considered a kind of leading indicator for broader employment. So if you look at this chart on the left-hand side, you can kind of see the blue line there is temporary hiring and your year-over-year growth in it. And when that began to crater early in 2020 or 2001, prior to the wheels fully coming off the bus in the dot-com bubble. It wasn't long before overall payrolls finally declined later that year, and coincident with the start of that era's recession. Kind of the same thing in the financial crisis. This began to deteriorate in about late 2006, early 2007, and broke below zero. The overall employment lagged, but not by that much. And by the time it broke through, we were about at the start of recession. Wasn't as much lead time in the lead up to the pandemic. Obviously, that's kind of a different situation. But you kind of look at where we are now and you say, oh gosh, that's a really big drop off. But you know, where's the echo here from overall payrolls? It's not really corroborated that weakness in temporary hiring. The cycle is a little bit of a different one. It's been such a strong labor market that if you're only offering temporary work, people are moving past opportunities. This is going back to kind of 2021 and 2022 era. But anyway, the long held pattern there is broken a little bit. But total hours worked is another gauge. If people don't have enough to do on the job, that's an indication of a softening labor market as well. And you know, if you look at overall private sector workers and the average hours that they're working every week, we're right now below the low end of the range of the prior cycle, right? So we're there's this kind of points to maybe a degree of hoarding of workers or simply not as much for people to do. So average hours worked is another one. And you know, I mean, I'm not trying to rain on the parade with any of this stuff or sully the otherwise strong labor market here, but this is just evidence of a job market that, you know, policymakers of the Fed are reacting in a big way now that the jobs report is finally showing payroll growth slow on trend. It hasn't really slowed the past couple of months, but on trend it has. And this rise in the unemployment rate. But, you know, it's not limited to these factors. You can see it in other places, job openings, for example. And, you know, you could go glass half full or glass half empty on this. Your glass half empty would be, my God, you know, we had more than 12 million job openings a few years ago. Now we're down to 8 million. Well, that's down by a third. If job openings are down so much, that must be bad news. Your glass half full would be, yeah, well, you know, 8 million job openings, that's still better than anything we knew prior to the start of the pandemic. So that's still pretty decent. And I think that's not too far off the mark in terms of a read. So we've got our first polling question coming up here, which is asking us if we're still participating. And I think even presenters have to participate. So I'll say that I am, just in case there's any doubt. And I'll encourage you guys to do the same. And I think I'm supposed to not move on here until everybody's weighed in. So if you're sneaking off and watching a YouTube video, unplug the headphones and click the button so we can advance to the next bit. As we wait for that to happen, I'm not sure where your pop-up comes up, but I can still see the quits rate and jobs are plentiful chart behind it. So I'll sneak ahead a little bit and talk about that while we wait for people to click the button here. So you've got the sorry. So what's the benefit of the quits rate? You know, this is I love quitters. And I know it sounds like a funny thing to say, but if somebody who quits a job, that is the truest gauge of, you know, swagger among employees, right? If you're feeling like, take this job and you know what, I'm out of here, that's an indication of a really strong labor market. And the inverse is also true. If people don't have the confidence to quit their job, then it's not nearly as strong a moment in the labor market. So if you look at that blue line is the quits rate, and it's lined up with the axis on the left-hand side, and you say, all right, so we're at 1.9% right now. That's a far cry from 2.9% where we were, you know, a year and a half, 2 years ago. But, you know, it's not terrible. It's kind of in 2016 level. We're sort of back to the middle part of the prior expansion. It's yet again another way of saying labor market's okay, but it's definitely lost momentum. And one of the things that, you know, when I mentioned Claudia Sahm and her Sahm recession rule indicator, one of the things she said was so many people have come back into the labor force, and they're coming from all places. When you look at prime age employment to population ratio, or we could have used the participation rate here, or pick your way of looking at this, but essentially a way of saying, are people out there in the labor force? And, you know, for a long period after the financial crisis, the answer was no. I mean, these numbers were, you know, kind of stuck in the 70s for a long, 70% kind of numbers here for a long time. That's about as weak as we had seen since coming out of the recessions of the early 1980s. And it really takes a strong labor market to pull people back in. And, you know, this gauge being at 80.9% as it is today tells you that the labor market's about as tight today as it's been since, you know, the early 2000s. I think that's kind of rounding this thing out to say, you know, what's the point here? I've kind of said the labor market's strong, the labor market's weak, you know, which is it? And I think the answer is it's weakening. It's not the period that it was a couple of years ago, where it was signing bonuses all over the place and a bidding war for labor, and, you know, first-year analysts on Wall Street weighing their options and demanding, you know, larger signing bonuses, and at the other end of the spectrum, people working at, you know, low-end job McDonald's workers getting a $500 signing bonus. We're not there anymore, right? But it's also not mass layoffs and looking over your shoulder and pink slips getting handed out left and right. It's just a little bit of not a weak labor market, but a weakening, or coming off of the white hot environment that kind of characterized the labor market a year and a half, 2 years or so ago. And employment costs are cooling, but have not yet come back down to earth either. So, you know, growing at north of 5% for a period. Now we're down to only 4.1%. So that's cooled off, but it's also growing faster than it has at any point in the prior 20 years. And so I guess that's a way of kind of saying, yeah, it's cooling, but not cold, right? And if you're an employer, what that means is, yeah, that's a big input cost for you. And, you know, if that's indeed the case, then your profits are kind of under pressure from that. Now, these numbers actually were, as initially reported, negative. This comes from the GDP report. You're probably aware GDP figures are subject to revisions, sometimes comically large ones. And in the latest revisions, they're no longer falling into negative territory on a year-ago basis. But you could certainly argue that corporate profit growth isn't as strong as it was. And I think what you're seeing there is an inability for employers and businesses to pass on those price increases that they're facing in so many other places. So all this time so far, we've only been talking about one half of the Federal Reserve's mandate. Fed's got two jobs, maximum employment. That's kind of what we've been going on and on about so far. Now the question is, what about the other side of the mandate? What about you know, inflation dynamics? And I'm gonna swing in and I don't know if this is allowed or not, but I'm gonna take a chance on it. This is the cover of today's New York Times, or the homepage of the New York Times, and the headline here says, "Inflation is basically back to normal. So why do voters feel so blah?" And I think that's a reality. I think, you know, here's the on the left-hand side, the Fed's preferred gauge, the PCE deflator, and it's now 8:31. So let's do some live breaking news here and see if I've got right. Okay, so mine is not okay. There we go. Yeah, so the PC index increased 0.2%, excluding food prices. Here, I'll show you what I'm looking at. So this is just coming in now. This is the latest personal income and spending numbers, and so when we kind of look at this and say, all right, so here's your month over month changes, here's your year over year changes. These are the newest numbers that just printed. So overall headline is at 2.1%. That's down from 2.3 before, and core stayed where it was at 2.7. So, you know, if you come back to the chart here, so this is a cute quarterly average. We were just looking at monthly numbers there, but we're basically right at the Fed's 2% target. So yeah, it's basically back to normal. So why don't we feel that way? Because inflation coming down doesn't mean the prices come down. You know, inflation coming down doesn't mean that a crappy lunch doesn't still cost $15. That's just the reality of the world that we're kind of living in these days. And yes, the consumer price index has cooled. Yes, the PCE deflator is cooled. And no, there aren't people in cahoots at the government that are lying about the numbers. These are all legit numbers. Is merely saying that the price increases from year to year aren't growing as fast as they were. Prices are still going up. And if you feel like prices are higher today, it's because they definitely are higher today. But the fact that they're nearing or at that 2% target for the Fed, and the fact that the labor market's losing momentum a little bit, is basically your baseline case for this first move on Fed funds. So they've gone from 5.5% to 5% on the Fed funds rate. After the election, we'll get the next. We have two more meetings, one in November and one in December. And whether we go another 50 or only 25 basis points at those meetings will depend largely on what the subsequent jobs reports look like. And it's at the best of times, it's hard to know what these numbers will be. But I'm joining you today from my home state of North Carolina, and as you probably saw in the news, Helene caused a lot of massive disruption in my state and in neighboring states and in Florida and parts of Georgia, and I'm sure even people in your neck of the woods were impacted by some of the storms as they made their way through. And of course, that wasn't the only hurricane in the month of October. So the October jobs report is apt to see a degree of disruption as well. And so if we kind of think about that in the context of all of this stuff, it doesn't mean they throw away the numbers from the jobs report, but they've got to take that into consideration a little bit. And if you were to see outright layoffs in the jobs numbers, let me go back a bunch of slides to these. Here we go. So if you were to all of a sudden start to see numbers below the zero line here, we're laying off 100,000 people on net, that would be okay. Maybe we need to get after it a bit more expeditiously with the rate cuts here to try to turn things around in the labor market. If, on the other hand, we see a continuation of more or less what we saw in September, where we added 250,000 jobs, well, then 25 basis points is probably plenty. If, on the other hand, the labor market's stronger than we all thought, and all these ancillary measures that I showed you are bogus, and we somehow add 300,000 jobs in October despite the hurricanes, well, then I guess all bets are off, and maybe they don't cut at all. So that's kind of the calculus that goes into it. Our bet is they deliver on a couple. No, here's our next polling question. So, are you still participating? We hope that you are. Please go ahead and click on that to let us.
Tim, while they're doing that question, just a question came in, and it's basically, how much is a good, strong labor market driving that inflation that you just referenced, since we're kind of on those two slides toggling back and forth, but that was relevant.
Yeah, the short answer is a lot. And you tend to see that more on the services side of it. Ben, you probably remember in the summertime, I had one of the slides in my deck was super core inflation. And super core is essentially just core services minus housing. And it was basically saying, the service sector is doing really, really well. And because of the service, because let's say this in normal human terms, bars and restaurants are packed, right? The housing market might be struggling, but getting a contractor to return your call and show up at your house is still pretty difficult. If I miss for work or travel or something, if I miss a dentist's appointment, they're like, yeah, forget it. You can't come in for 6 months. So there's still a lot of places in the service sector that are really, really backed up. And this tightness in the labor market and this still high level of activity in the service sector means that services prices have been slower to come down. Not because businesses are profiteering, as some politicians would have you believe, but because businesses face those high input costs. Remember the slide with the employment cost index, and they're seeing their input costs come down, but not swiftly enough that they can, if your input costs or employment cost index is 4.1%, right? If that's your mood music, that's how much your input costs are growing. How much do you increase venue prices? How much do you increase, dental cleanings and minimum surcharges to send a plumber out to the house? Like, it's hard not to pass those price increases on. So yes, that's a key piece of it. But somewhere out there right now, there might be somebody who's tied to something in the manufacturing sector or anything in the durable goods space or in, sales of RVs or boats or jet skis or appliances. And they're probably like, don't talk to me about a strong labor. Are you kidding me? Because all of the demand for a lot of those durable goods was pulled forward during the pandemic. And so, there's a little bit of when demand gets pulled forward, there's kind of a pocket, an air pocket after that where demand isn't as strong. And then on top of it, most people don't go out and buy a durable good with money in their bank account. I know there are some people, Ben, you probably do that, but not everybody is in such good a position to be able to do that. So they've got to, get a loan for this stuff. And with 150 basis point cut, as you can see here, doesn't exactly put interest rates at a low level. So your cost of financing those goods is still really high. And that means that the demand for the goods isn't as strong. And when the demand for goods drops, prices drop there. So what's my point in all that? Goods inflation is back in check. Services inflation, not so much. And so when you kind of look at some of these more core measures of inflation, the fact that they're running ahead of headline kind of reflects that dynamic. So great question, whoever that was. And that's as good a transition as any way to start talking about the consumer. So, whoops, I jumped one. There we go. So we are only taking this back to about 2005, and we'll look at a slightly longer time series in a second. But the point of this is to say, how is, when you kind of break out spending between the money that you have to spend and the money that you want to spend, how do things look there? And the money that you have to spend is the blue line. In fact, this is the year-over-year change in a category of spending that includes things like housing and utilities and insurance payments and interest payments. All of those things are kind of the money that you have to spend. And it doesn't tend to be that variable. It usually grows about the same. It can sometimes, get down low a little bit, but for the most part, it's pretty steady. And then the far more variable line is what you've got some say over, the discretionary spending, basically everything else. And that was on thin ice at various points this year. It was awfully, very close to the zero line. We're kind of back up to a point where the red line is above the blue line, but only barely so. If you look at the prior cycle, there's a lot more gap between the growth rate in discretionary and non-discretionary. So this is basically hard choices going on here when these are as close together as they are. And my argument is, when you see this discretionary line fall below zero, that's your real recession indicator. And if that's the case, this is how close we got to recession at various points in this cycle. Very kind of tiptoeing across that thin ice, but not quite breaking through it. And you can see here's what a normal recession looks like. Here's what the pandemic recession looked. It was literally off the charts on this. But now let's back it up and look at a longer time series. Okay. Now we go all the way back to the 1950s. And here you see that there's never been a recession that discretionary spending did not fall below zero. And there are also two moments, once for a short period here in the 60s and a very, very short period in 1987. This was right after the October crash and Black Monday and in the 1980s. And both of those periods were your only two head fakes where discretionary spending fell and you did not have a recession. And I would say, two mistakes in, what is this, 60 years of data, 65 years of data. That's better track record than I've got. And I've not been in the business anywhere near 65 years. So it's not a perfect gauge, but it's a darn good one. And, the other thing that I would point out is take a look at the blue line. And, it definitely fell during the pandemic, but during other periods, it skirts the zero line, maybe crosses it slightly, here in the recessions in the early 1980s, just a tiny bit below zero. But for the most part, even at the worst of times, even after 9/11, even after the dot-com bubble, even during the financial crisis, it just kind of gets very close to zero. But my point here is, when it comes to the non-discretionary outlays, for the most part, that doesn't decline. It really doesn't. So when you look at our forecast coming up here in a little bit, it's, that's something you have to factor in, that a lot of this spending is kind of on autopilot. None of this is to say that the consumers and, the backdrop here is absolutely perfect. Income is growing. Even after adjusting for inflation, income is growing, but it's not growing as fast as it usually did. The red line in this chart on the left is your 2016 to 2019 trend. And we just take that trend and overlay it into this cycle. And what you can see here is the last 2.5 years were certainly below that cycle. This period in late 2021 and early 22, when the blue line is going down, is essentially saying, nominal income was rising during that period, but inflation was rising even faster. So that line coming down says your real income growth was falling. It's not falling anymore, but it's not growing enough to get you back up to trend. And that's kind of this weird dichotomy that we've had. And I think this era is kind of over, but the pandemic era had this weird dynamic where income went up and spending went down, and then income went down and spending went up. And we're just now getting back to a more normal-ish state of affairs where income is growing more or less in line with spending, as it usually does. And we've been able to have these breaks for a couple of reasons. Early on, there was this big pile of money that didn't get spent during the COVID years, right? So this was not just the money that you couldn't spend in the service sector, but in some cases, the savings that got passed back to you from, maybe you might remember, like your auto insurer sending money back, like nobody's driving, so here's a refund on some of that. And there was, of course, all the stimulus from that period and a lot of windfalls for people. And, the stock market didn't do too bad. So we were kind of flush with cash for a while. That got us through a period, and then it dried up. And then more recently, you've seen a significant take up in revolving consumer credit. So here's a big increase in revolving consumer credit. And if you're hearing a stall in my thinking, I'm remembering you asked for pop culture references. I've done 0. So let's fold our first one in here. So there's 2 things to kind of think about. One is you've got a big pile of consumer credit. This is revolving consumer credit. So of the 1.3.5 trillion on here, maybe 1.1.5 of it, or almost 1.2, is credit cards. So this is a big increase in credit card spending, is what you're essentially seeing there, credit card borrowing. And that's only a relatively short look. In the chart on the right-hand side, we go back a little bit farther. I might even use a prop, see if I can go find a record from the band. But there is a band that released its first studio album in 1995. They are still together today. So you might want to think about what that band is. But in the entire history of that band, we've never seen credit card interest rates north of 17%. Today, in the past couple of years, we've broken through that. And it's almost as though every time we get new data on this, we have to change the scale on the chart to accommodate it. So you can think about what that band is. And I don't know, maybe when do we check in, Ben, when we do the next pop-up window?
Yeah, I'll do something like that. But we did just have another question pop in.
Okay.
So there's a polling question right now. So if everyone wants to answer that, I'll go ahead and ask Tim a question, and we can kind of curious. How does China, Russia, and North Korea's investments in our capital market and real estate impact the overall stability of our economy? Or is that
sorry, I heard it was Russia and China and the stability of our economy, but what was it? How's their?
How does China, Russia, and North Korea's investments in our capital markets and real estate impact the stability of our economy?
Okay, got it. Yeah. Right. So foreign direct investment as a share of economic growth is a way to kind of measure that. And some economies are very much reliant on foreign direct investment to drive economic activity. The United States is in a situation where we're really very, very resilient to that. Most of the capital flows globally are still going through the U.S. capital system, and you've still got hedge funds and asset managers and private equity that is more than happy to finance good ideas here. So the absence of capital from Russia, China, and others that are not our closest buddies these days is not necessarily a super negative impact. But if I could lean on the question a tiny bit, there are some other ways that it does impact it. And one is, from the time that China joined the World Trade Organization, and I forget if that was 2001 or 2002, but from then until about 3 or 4 years ago, a chart of Chinese holdings of US Treasury securities more or less went straight up. And starting around the time of the trade war during the early to middle part of the Trump administration, the Chinese started to be like, okay, well, if you're going to be jerks about it, we'll stop buying all this Treasury debt. Now they're depending on what month it is, and the place to look for this is Treasury International Capital, or TIC, a report that comes from the Treasury Department every month. And it kind of says, what are the net foreign purchases by country of US Treasury holdings? And, even though they're not our biggest fans, there are still some months where the Chinese increase their net holdings of US Treasuries. But on trend, since about 2018, they've been winnowing their share of their purchases of Treasury securities. That puts them now in the number 2 spot among foreign holders. Now we're back to Japan as the largest foreign holder of Treasury debt. But it's not as though the United States is having difficulty financing its debt. I mean, whether you're talking about, a teacher's pension fund in Europe, or, some poor guy who's managing the portfolio for the Sultan of Brunei, you have to have an anchor to windward in your portfolio. You need to have your oh shoot money in something that's very, very safe, very, very liquid, very, very stable. And for better or for worse, that's for the most part dollar denominated Treasury debt. So, the Russians have never been big buyers of it. The Chinese are not the major fans of it that they once were. And as a result of that, all else equal, our Treasury costs would be a little bit higher. When we, later on, if we start talking about the fiscal budget situation and components of the federal spending that are increasing, of the major lines of federal spending, the one that's growing the fastest is financing the debt. And our cost of financing the debt increases, all else equal, when there are fewer buyers of it out there. Okay, so then the next question would be, okay, well then how much is, of the current yield on the 10-year Treasury, how much of that is attributable to China? I don't friggin' know. Nobody does. That would be, I'm sure somebody out there would give you an answer, but I think they'd be full of baloney. But at the margin, a lack of buyers there becomes problematic for financing the debt. Having said that, we still enjoy the lowest costs of capital for our debt. And, I don't think that we should rest on our laurels on that, but it's not as though we're having a tough time financing our debt in the meantime.
All right,
Just
so quick, then.
Yeah.
Sorry, just two quick questions. One thing, we do have the right answer. I think we've got I probably should have given my email out to 375 people. That's a recipe for filling my inbox quickly, but do have the right answer.
You need shouldn't you have to turn your screen on when you're talking, Ben? I think you should be on video if you're talking.
All right, I'm happy to.
Okay.
So we do have an answer. I can't remember who it is off the top of my head, but we got a bunch. It's Foo Fighters.
Okay.
Is that right, Tim?
That's a bell ringer, correct? Yeah, Foo Fighters.
Lots of good guesses, but Foo Fighters is the right one. So then 2 quick follow-up questions. Basically, and I know we don't want to slow your presentation down too much, but a lot of questions around credit card debt and personal debt. What I think is relevant is, with inflation, credit card number naturally would be higher. We saying credit card debt is still high after adjusted for inflation.
Great. Okay, good. So I can actually transition from that into the next piece of it, because that's totally fair. And I'm not being disingenuous when I show you this is nominal. Whoops, over here. This is nominal. This pile of debt over here is in nominal terms. And it maybe, from some perspective, exaggerates the problem a little bit. And, so if you look at in dollar terms, from this peak here in the financial crisis to this peak here during the right before the start of the pandemic, the dollar increase there is about $80 billion over a period of about a decade. All right. And then you say, all right, so what's the change from that peak, not from down here after this stuff fell during the pandemic, but from the pre-pandemic peak until now? That's about 250 billion. So that's like 3 times as much in less than half the time. Now, the person's saying, yeah, but that's nominal. You're not adjusting that for inflation. And I would say fair. And I'm not trying to be nefarious with that. There's just not a sensible way to deflate a pile of debt, because you don't want to just take the PCE deflator or some measure of consumer price inflation, because that's not, it's not appropriate to do that. And I don't think you'd find the serious economist out there who'd say it's a good idea. But one thing that you can do to try to normalize it is look at it, say, look at total debt to income, right? So if we, this is basically saying, hey, look, it's, if your debt is growing, but it's because of high inflation, well, then your income should be growing in a high inflation environment too. So putting one as a numerator and one as the denominator kind of fixes it. And there are many people out there who look at this and say, this is good. This is fine. Debt to income. Look at it. What are people worried about here? At 87%, we're lower than we were at any point during the prior expansion, and most of where we were since the turn of the century. We're, admittedly a little bit higher than we were during the post-pandemic era, but on balance, looks good. Okay, so that's the good. But I would say I kind of got a problem with this, because this is not just consumer debt. This is also mortgage debt, and mortgage debt is much, much bigger as a pile than the consumer debt stuff is. So if we just look at revolving debt as a share of disposable personal income, okay, now this still doesn't look too bad. I mean, it's still not really all that high. So this is if the person's beef was to say, hey, you're not inflation adjusting that pile of debt, here's the fix for it. Here's to the same thing, revolving consumer credit, except now expressed as a percent of disposable income. And they're right. It's not as bad when you look at, certainly higher than it was a few years ago, but still lower than it was during this period. So you've got to take the good and take the bad. If you take them both, there you have this popular sitcom from the 1970s. I can't believe we're doing this, Ben. But we'll check in later to see if you perfect. So this is perfect. We've got our next polling question. So who can complete the line for us? And as we're waiting for that to come in, I'll repeat it. You take the good and you take the bad. You take them both, and there you have what? As we're waiting for it, I'll give you the bad part, which is personal interest expense on the right-hand side. So this is non-mortgage interest as a percent of disposable personal income. In other words, what's the interest piece of my credit card payment, my auto loan payment, my student loans, anything that's not a mortgage? How big is that as a share of my income? Well, now you're talking something that's about as high as it was since we were coming off the financial crisis. Okay, Ben, did anybody get it?
I have not clicked back, but while you're talking about the debt piece, excuse me, I heard you talk the other day about the kind of buy now, pay later. Can you talk about that and how that kind of integrates into the consumer debt and how that's measured, if at all?
Yeah. So I call this, what a perfect theme for Halloween, Ben. I call it phantom debt. Phantom debt because what are phantoms? They're something that's scary. It's something that you really can't totally see. You're not sure if it's there or not. There's a line in the Phantom of the Opera where he says, oh, shoot, I blew it. I could have used that as a public pop culture reference. But he says, I just want to live like everybody else. And I think there are a lot of consumers that feel that way. I just want to live like everybody else. I want to be able to spend money. And, maybe I'm tapped out on my credit card, or maybe the bank won't give me a credit card, or maybe I just don't want to get into that nonsense and I don't want to deal with a credit check. I just want to break this large purchase into 4 or 6 small payments without interest over a short period of time. And if you're hearing this coming from a banker, you might be like, oh, he's just talking his book. He wants to preserve credit cards for the domain of banks, and I don't blame you. I'd have the same degree of skepticism there. But what I worry about is that there might be these consumers that are like, yes, rather than, if I'm going to buy a new TV or a new computer or whatever purchase it is that they're offering this buy now, pay later on, it could be the sort of thing that, it gives me a small monthly payment, but I might wake up one morning and all these things that I've done through buy now, pay later add up to all of these small payments, and I'm getting nickel and dime to death and kind of bound in by them. And for the Federal Reserve and for economists, we don't know how much is out there because these firms aren't required to disclose the way credit card providers are. So there's not I can't make charts and graphs with it because no one knows how much is out there. So it's a large amount. We don't know exactly how much it is, but I do worry about it. Do we have an answer yet?
So then, yeah, we do. I would guess it's the facts of life. Is that right?
Are you guessing, or did someone come in with it?
No, I got a lot of answers, but I don't know the answer. So
It is the correct answer is the facts of life. Yeah.
all right, Rita Fox wins it. So
All right, Rita, well done.
so anyway, we do have some other questions, which we will certainly send some email responses. I don't want to bog Tim down too much, so I know we've got some content to get through. But Tim, I'll let you get cracking again.
Okay. All right, I'll jump in, and I'm at risk of going a few minutes over here, but I'll aim to have this all wrapped up inside of 10 minutes here. All right, so consumers are struggling a little bit, and you can see that with auto loans and credit card delinquency rates rising. They're not at terrifying levels. They're not like where they were in the financial crisis, but there's the argument a rational person could say, look, there are people out there that are struggling right now to make ends meet, and you're seeing that in some of these measures. So this chart kind of overlays consumer spending in every major expansion that has lasted at least 6 years. So we kind of skip the short ones in the early 1980s, but we kind of say, like, how do these look? So you're going back to the 1960s until now, and we are this kind of dark blue line that ends right about there. And we're saying it kind of continues to grow, but at a flattish trend over the next couple of years. In other words, still growing, but not blowing anybody's hair back. And you compare that to other economic cycles, and this is the second worst of all of them. So you can describe how you want the outlook for that, but on balance here, it's a case for measured pace of consumer spending. I'm going to skip ahead a little bit to the outlook for business fixed investment. So overall, business outlays are historically a very steady share of the economy. It's usually between 10 and 15% of the economy. And it's, as you can see, going back to the post-World War II until now, that's been a pretty steady piece of it. During recessions, it may ebb a little bit. During sometimes it can look like it increases in recession because business spending stays steady and the economy falls apart. So it looks like it goes up, but it's actually the denominator moving. So on one hand, nothing's changed, but another way of looking at it is things have actually changed quite a bit. The composition of spending in this cycle, I'm not saying this time will be different. I'm saying this time already is different. In the past, when you look at business fixed investment, it's entirely a discussion about the red line, equipment outlays, right? What are my non-defense capital goods orders look like? What does the orders component of the ISM look like? I care about these things as an economist because they tell me about the outlook for equipment outlays. Well, guess what? That made sense in a world where more than 50 cents of every dollar spent was on equipment. But there's been a modest trend decline in place here over the last 30 years. It was still king, even as recently as the 2010s. It was still the biggest category, but now it has been displaced by this blue line, which is intellectual property products outlays. So all business fixed investment falls into 3 categories. This is a very, very old pop culture reference, but Gall as a whole is divided into 3 parts. Who said that? So business fixed investment as a whole is divided into 3 parts: intellectual property, equipment, and structures. So in a second here, we'll drill down into the subcomponents of each of those 3 categories. Before we do, though, I just want to make one point about this current cycle. So if we index things to pre-pandemic, which we do on the next slide. Okay, whoops, I overshot it. Here we go. So if we index it to the change from the 4th quarter of 2019 and say, how have these all kind of played out since then? Well, overall business fixed investment is up 18%. The equipment piece is up 9%, so middling sort of performance there, not blowing anybody's hair back there either. And structures, 4.1. Structures actually fell for the most part, and then it's probably growing faster than the others more recently, but as relative to where it was pre-COVID, it's up only a little bit. And you're probably already ahead of me. Intellectual properties is where the party is at. That's where all the growth has been in this cycle. Okay, so now we'll drill down on this. And so here in this chart, these are all of your categories within structures, intellectual property, and equipment. So the biggest overall is structures. We'll come back to that. Manufacturing. We're building more factories. Capital outlays on factory construction is the biggest category. We'll come back to that in a minute. Intellectual property. We got our first category here, software spending. Well, no kidding. You know, anything that has to do with software outlays has been growing like mad. So it's up more than 50% from where it was pre-COVID. Next biggest, another intellectual property, research and development spending. You know, this is in an era where we've had ChatGPT introduced and this, you know, rise of AI and faster processing. No one wants to get left behind in this. So we're spending big on software, spending way big on intellectual property and research and development. Oh, good. We finally got an equipment category. What equipment is it? Is it going to be fabricated metals? Is it, you know, industrial supplies? No, it's information processing equipment, computers. Okay, well, that's barely equipment. Fine, but equipment's at least represented here. And now what I've done is I've grayed out everything else. Like these are all the other categories. And my point here is it doesn't matter. These guys are all below the trend for overall industrial production. The point is to say, this is where all of the action is. Now, a reasonable question would be, why are you seeing that kind of growth in structure spending in a world where manufacturing production has been flat for the last decade? And I'm not picking on manufacturing here. I'm just saying that's the reality. Well, when you kind of drill down at the components of it, you drill down at the components of manufacturing construction, this is kind of what it looks like. These 4 lines down here, chemical, food and beverage, transportation, and other, you know, modest sort of growth. For years, these were the larger categories. And then there's this little baby category down here that barely gets any respect. And that little baby category has gone from the smallest category of spending overall to by far the largest, a 10-fold increase in the past couple of years. And that is computer and electronics manufacturing facilities. This is the boom in construction for these chips facilities, microprocessors, semiconductors, wafer boards. I don't hold myself out as a guru in that space. I don't know exactly what's going on. And yes, a lot of it is the passage of the CHIPS Act, which spurred a lot of investment in that space. Although I would point out that more than half of the outlays there are not in public dollars. They are private dollars coming into it. The chart on the right is basically saying, you know, you already saw this earlier. This is your non-energy manufacturing line. That's flat to down over the past 7 years. The red line is selected high-tech industries production. So the left is building the factories. The right is the output of factory. So the output of high-tech is up more than 50%, almost 60% over the past 7 years. That might be just the beginning of a really big increase in production capacity for these guys, if indeed we're building 10 times as many factories as we were before in that space. So that's sort of a natural stopping point because I'm getting ready to start talking about housing. So if we can call the transition, I don't want to give it away, but who said Gaul as a whole is divided into 3 parts? Gallia est divisa in omnes tres. I finally get to use Latin.
So I got a bunch of answers. I think they're all right. So I kind of gave it away there.
All right. Nobody. So we have answers. Does somebody have it?
Yeah, a bunch.
All right.
Julius
So
Caesar.
yes, correct. All right. Nice. Great. You seem very disappointed in that pop culture reference, man.
If pop culture is from that long ago, it's not really pop
All right.
culture anymore. But
I'll try to do
go
better.
ahead, Tim. Proceed.
Okay. All right. So let's talk housing for a second. All right. So let's talk about the 10-year before we even do that. So we'll look at the yield on the 10-year. So here's where the Fed began communicating its intention to lower rates. Then it finally delivers on a rate cut, and the yield on the 10-year rises in response to that. And just ask yourself, how many times in your career you remember that happening, where the Federal Reserve cuts, does a 50 basis point cut and says we're going to keep lowering rates, and the 10-year yield rises in response to that. Kind of an unusual backdrop there, but that's not actually the point of this graph. The point is rather to say, look at the spread between the 10-year and 30-year mortgage rates. And here you've got, kind of a widening in that spread. Here it is just in terms of the spread line itself. So I kind of drew those lines on there at 150 and at 200 basis points. That's usually, where it lives. So here's a pop culture. I can't believe I'm doing this. This is where you live, right here. This is where you live. I don't want to see any lawnmower. I don't want to see any Q-tip. This is where you live. So what is
so
that?
easy. So easy.
Well, you don't get to do it, Ben. This is for
I know.
participation. And we've been way outside of the range here. We've been living in this, lawnmower Q-tip range of, 300 basis points on the spread between 30-year mortgage rates and 10-year. So what does that mean? It means nobody wants to move out of their house. Existing home sales have fallen to their lowest level in 20 years. Who wants to leave when they got a 3% mortgage? And, if they're going to move down the street or downsize or upsize or go anywhere else that they're going to have a mortgage, it's going to be double the financing costs based on the current market environment for mortgage rates. So it's put a chill into the existing housing market. Not quite so much in terms of residential construction activity, which has rebounded a bit. But when you look at the composition of the inventory that's out there today, it's usually, the blue is the big piece. That's existing home inventory. The red on top is just the new home inventory. And my point here is look at what a big share the new home inventory is today. And our bet is that more or less continues. So despite high mortgage rates, residential construction activity is not going to fall out of bed like it did during the post-financial crisis, post-housing boom. It just sort of mellows out and hangs out at this level for the next couple of years. So what does this mean for home prices? A lot of volatility around home prices. We've kind of been all over the place, but for the most part, and your mileage may vary, it's kind of, initially kind of a scare as rates came back, but then home prices have kind of rebounded. So I'll end on this slide here, Ben. Here's our forecast for GDP. It's not the world's most compelling forecast, but this is essentially where we see the outlook for the overall economy headed. Kind of 2%-ish sort of growth. That's more or less at potential. And you might think to yourself, no, the economy usually grows much faster than that. The truth is today, based on labor force growth and capital spending plans, 2% is probably a realistic speed limit. So did anybody get our last pop culture reference? And then I'll sign off.
Yeah. Andrea Papa got it. Hitch, right?
That's it. Hitch.
That's a good one. Hey, one other just quick question that came in. Kind of what's there's a polling question right now if you guys could answer it. And this may be in your slide deck, Tim, but do you have any quick commentary on rates outlook that would be valuable to folks as they continue to plan for 2025 and beyond?
Do I have a rates outlook? Yes. Will it be valuable to folks? Well, hard to say. We do a halfway decent job at forecasting stuff. If you look at like Bloomberg is like rankings for different indicators, we are right now holding the #1 spot for GDP growth. We're like 3rd for industrial production. So some of this stuff we do okay. Nobody stays in the top spot for forecasting rates because it's a random walk. And economists who tell you with great conviction this is where rates are going to be are full of baloney. But for what it's worth, here are the lines. The Fed funds rate, I've got greater confidence in than the 10-year yield because this is largely a function of the outlook for labor and prices. And, I ought to know something about that. And so if those numbers are right, you're going to see the Fed kind of gradually getting rates down to 3.5, 3.25, and then kind of hanging out at that level. So this will not be like other periods where they go all the way down to the zero lower bound. They get to kind of what economists call a neutral rate of Fed funds, which our number is around 3.25. In terms of the 10-year, it's not that exciting. We go from, 380-ish as a quarterly average yield in the fourth quarter of this year to 360-ish as a quarterly average yield by the end of 2026. So basically kind of range bound, slightly lower, to to believe in much higher or much lower. You've got to kind of adopt an outlook that's not consistent with what we're basically serving up as a baseline expectation here. So that's what we think. I've got a fair degree of confidence in the short term, shorter dated, the Fed funds rate. I would, of all the lines in our forecast, I have the least confidence in our 10-year Treasury yield, because I've learned humility after a few decades of doing this, that it's just, we don't do it well, and neither does anybody else.
I'm going to put you on like a 45-second clock. Last question, and then we're going to move on to Chris. But can you comment on how significant government stimulus has been on economic growth over the last several years?
Yeah, I mean, since 2017, we've been in a sugar high. We've been in a false world of, what looks like normal growth of 3-4%, and that's bogus. We had stronger growth in, the Trump tax cuts, the Tax Cuts and Jobs Act of 2017 was undeniably good for the economy. That's not a partisan statement. I'm not in cahoots with the MAGA crowd. It was good for, tax cuts are rock free. They expanded the budget deficit, and we were on a trajectory toward balanced budgets before that happened. Then it took us off that trajectory. We began running bigger budget deficits. Then under Trump, you had the CARES Act and the December COVID relief bill. And then under Biden, you had the American Rescue Plan, the CHIPS Act, the whole bunch more of it. He did more than Trump did, but they both did quite a bit. And among the G7 economies, we had the fastest growth the past few years. It's not because we're awesome and those guys are lame. It's because we kept pouring excessive stimulus into it. And that's great, but that begets higher inflation. It does give you faster growth, but it also gives you higher inflation, and it gives you a major hangover, which is huge budget deficits and a big national debt. So not how I would have played it, but did it help? Yes.
Gotcha. Well, Tim, as always, appreciate it. Got a couple comments. We seem like Abbott and Costello. I don't know if that's a compliment or some sort of negative comment towards us. But anyways, hopefully this is kind of a fun portion for CPE. Certainly very informative with Tim's commentary. If you've got questions, apparently everyone has my email, so feel free to email me, and we'll happily connect you with Tim if you've got specific questions or need more data. So Tim, thanks as always for joining us.
Thanks. Take care, everybody.
I think next we're going to jump to my colleague Chris O'Gene, who has been nice enough, as you can tell, he's traveling. He's nice enough to dial in from the road. Chris is based here in the DC metro area and is our regional investment banker. He's going to give some commentary on the three things I mentioned, kind of debt, equity, and M&A markets, kind of what's going on, what we've seen, what to expect, industries, et cetera. So with that, Chris, I'll let you take it away, and I'll chime in as questions arrive.
Yeah, and as usual, Ben, when I follow an economist, I have to cut my presentation short because he goes over the allotted time. So I'll try to make
part of that's my fault.
as efficient as I can. And as Ben said, if there's questions as I go, just feel free to kind of put them in the queue, and Ben will ask as we're going through it. So we're going to start with the M&A market, then we'll go into the equity market, and then the debt market to finish things off. On the M&A side, on the first slide here, what I'll do is focus on the bottom part of the slide. If we can get to the next slide, please. Give you a sense of what we're seeing in terms of takeaways in the current market environment. First one is just the backlog of M&A processes and IPOs. What you're seeing now with the election uncertainty, people trying to finish deals before the end of the year, but waiting to launch new processes until we get into 2025. And we'll talk about the M&A market in the next section, but that's another issue as well, where the M&A market was shut down for a long period of time, but is now, because of the strength of the equity market, has opened back up. So companies have kind of rushed to market at the end of 2024 with a big backlog of expected IPOs in the beginning part in the first quarter of 2025. The next bucket talks about the financing market. So we saw a bit of a slowdown in the M&A market, and you can see it in the chart on the top right in 22 and 23. So as interest rates rose, the cost of financing a potential acquisition went up pretty dramatically. Now that impacts strategic or corporate buyers, but it really impacts private equity firms. And we'll get to kind of the implications of what that's had on private equity community in general in a couple slides. But the long and short of it is, if it's more expensive for the private equity firm to borrow, if they can't borrow as much debt, they can't pay as high of a price as they could maybe in 2021 when the interest rate environment was more moderated. So what we did is saw a slowdown, or we have seen in 22 and 23 a slowdown of private equity activity. We're starting to see that ramp back up in 24, and that's why that's part of the reason why the 2024 year-to-date performance it has increased a bit. So overall, a very supportive financing market, which has helped to spur some activity as well. The next bucket talks a little bit about the dry powder from private equity and corporate. So we've seen a significant amount of demand in 24 from the corporate buyer community. Part of the reason is more supportive financing markets, which we discussed, but also CEOs are feeling very good about their stock price given the strength of the equity markets. So that spurred demand. And then on the private equity side, there's been a pretty significant influx of dry powder into that asset class as folks have looked to take advantage of the performance of those funds over time. Significant amount of money has flowed into the private equity asset class, increasing demand from that community to put that money to work. The next bucket is core assets and exiting non-core segments. So this talks a little bit about where the demand is coming from the strategic buyer community. So when we meet with strategic buyers, one of their core thesis, and this really goes across all industry segments, has been to add on to their core business. And if the acquisition is maybe a new leg to the stool or in a non-core segment, there hasn't been as much interest in that acquisition. So it's really a focus on adding on to what the company has and what they do well, and maybe not entering a new industry vertical. And then the other part of that takeaway is we've seen a significant increase in divestiture activity, and that's really across all industry segments. And one of the main reasons is the investor community amongst the public strategic buyers has really rewarded the pruning of portfolios and really a focus on the core business. So we've seen a number of, certainly in the industrial space specifically, of some of these larger industrial conglomerates exiting what they would say are non-core businesses and spinning those off. And that has been a big focus of the private equity community. And one of the things they look for are orphan businesses or non-strategic assets that they feel like under their ownership, more focus can really drive value for them over time. So that's been another trend that we've seen in 2024. The next bucket is profitability and free cash flow. So when folks are looking at acquisitions, a core focus and what really drives what we would say the higher end premium valuations in the sector are going to be businesses that are highly profitable, have high gross margin and EBITDA margins, and then also limited CapEx and working capital change, which is going to drive significant free cash flow for those acquisitions. So the companies that are really generating what we would see as the higher end of the market from a valuation perspective are ones that check those boxes. And then the last bucket is a really important one, and one that's changed a bit under the current administration, has been an increased scrutiny from a regulatory perspective. And actually, Wells Fargo is a part of one of the larger transactions in the space, the Kroger-Albertsons transaction in the grocery sector, where Kroger spent a ton of time trying to figure out the regulatory environment and actually came to an agreement to sell a bunch of stores as a way to help the transaction from a regulatory perspective. And one of the other interesting dynamics from a regulatory side is it's not just the multi-billion-dollar transactions that are really being scrutinized by the government. It's really even transactions that are below $1 billion in sectors that you would not think would be a focus area for government regulation are really, one of the first questions that we get from strategic buyers is what do we think the impacts would be from a regulatory perspective? And companies are really having to factor that into their thinking before they pursue an acquisition. And that's really a change from, several years ago when there wasn't that scrutiny from the government. Next slide talks, and this is really a focus on the U.S. Market, not necessarily taking into consideration what we're seeing internationally, but we have seen a pretty significant uptick in deal volume in 2024. The industry segments that are really driving that are the oil and gas sector with the ExxonMobil Pioneer deal, which was a $60 billion transaction. We're seeing it in the healthcare space, which has always been an active sector, but that's driving pretty significant volume. And then really the tech sector. And what we're seeing on the technology side is the impact, obviously, of AI, so that we've seen a number of transactions in that space. But then just broadly speaking, companies really looking to improve their technology capabilities. And that's been a big part of the deal volume. And then the last point I'd mention on this slide is activist campaigns. So that's where activist investors are coming into public stocks. You can see that it's up 50% this year. And what that is an activist investor coming into a stock and forcing the company through equity ownership to either divest non-core assets or in many cases put the entire company up for sale. So we've seen that be a big focus area in 2024 in terms of M&A volume.
Hey, Chris, any surprises in M&A and there's a polling question right now if everyone on the call wants to answer that. But while that's up, any surprises in M&A, specifically across the Mid-Atlantic that, maybe outside of some of the big ones you answered? And this can be anecdotal that you've seen just in your practice.
Yeah, I would say one of the things that we've noticed is the SPAC market, which really drove M&A activity in 2021, had been out of favor in 22 and 23, but that market is coming back a bit. So companies asking, is that an option for me? It's kind of a backdoor way to go public, but that it really drove IPO volumes in 21 and 22 is kind of come back in favor a bit, which I would say is a bit of a surprise. And then I think the other thing that I would say is a bit of a surprise is that sellers' expectations, we feel like, have moderated a bit. And that's one of the things that drove, I would say, the decline in volumes in 22 and 23, where you had a rising interest rate environment. So buyers were saying, well, it's costing me more to finance a transaction than it did previously. So as a result, I can't pay as high of a price. But sellers were really not accepting those price declines. We're starting to see valuations moderate a bit, which I think is good news for the buyer community.
Cool, thank you.
All right, just make sure everyone participates in the polling. I'll go quickly through this next slide, but this speaks to the M&A volume. You see 21% increase year to date. And I think, and I mentioned this previously, but one of the main drivers of this is we see M&A volumes as a bit of a CEO confidence game. So when CEOs feel good about two things, number one, the outlook for their business and the valuation that their company trades at in the public markets, we typically see an increase in M&A activity. And that's one of the dynamics that we're seeing right now, where companies are feeling better about their outlook and where they see things going. So that's driven a bit of the volume this year. Next slide. So this speaks to specific, and I'll go quickly because I know I'm running up against time here, but 50% or so of M&A volume is driven by the private equity community, and really the main driver of what we've seen in terms of sponsor volume is the chart on the bottom right. So as interest rates have moderated and come down a bit, private equity firms can pay higher prices for businesses, so they're getting more deals done. Although I will say private equity exits have declined pretty dramatically in 2024. And one of the reasons for that is we saw a significant amount of M&A activity from private equity firms in 2021. And the hold period for private equity is typically 3 to 5 years. So right now we're kind of inside the window of the typical hold period for private equity. So what we expect to see in 25 and 26 is increased exits from private equity, which we think is going to drive pretty significant M&A volumes in 25, 26, and 27. We can flip to the next section to get into the equity capital markets update. So I hit on this a bit already. You can flip to the next slide, but there's a couple things here to note. Both follow-on offerings and IPO volumes are up pretty dramatically in 2024. The IPO market was effectively closed in 23, so we saw a significant amount of backlog of companies that were waiting to go public, and there's been a pretty good amount of deal volume in 24. A couple of large transactions in the tech space, Reddit and Tempest AI, large deal in the industrial space, company called Standard Arrow, and a healthcare business called Astera Labs that really drove, they were kind of the first movers in the public IPO market. And then as those deals priced and did well, there's been an influx of businesses into the space. The other thing I'd note on the equity side is the convertible debt market has been relatively red hot for the last couple of years. And one of the reasons behind that is in a rising interest rate environment, convertible debt is a really attractive option because the upfront interest rate associated with convertible debt is very low. So when it costs companies more money to borrow, we see more volume in the convertible market. And then I also mentioned the SPAC market has come back a bit, which drove really significant significant IPO markets raises in 21 and into 22 a bit. That market has come back a bit in 24, which is helped to drive additional volume. Next is the debt market update, and really we focus on the three kind of main markets here. The first is the traditional commercial banking market, so that's the pro rata market. That's the market that Wells Fargo participates, where we actually hold credit. That market is more what I would say relationship based. It's been very functional for the last several years. So corporates have had access to that market. In terms of where that tops out from a leverage perspective, it's really, call it 3.5 times, maybe 4 times in certain instances, but pricing and spreads are at historically low levels. So that market is very well functioning. Next market is the institutional market. So this is the term loan B market. So this is a market where when corporates or strategics are trying to increase leverage, maybe above that 3.5 to 4 times level, they access this market. There's also a significant depth to this market, meaning if you're in the commercial market, there's a maximum level of debt that you can actually raise, but essentially this term loan B market is the depth to that market is multi-billion. So we've seen issuances up almost 100% year over year, and that doesn't even include repricing. So one of the dynamics in the term loan B market is once you have an existing issue, you can go out to your existing holders and essentially reprice your deal. So we've seen a significant amount of repricings in 2024. So as interest rates have declined, existing issuers have gone back to their holders and repriced the loan and lower their effective cost of debt. And the last bucket is the high yield market. We've seen you can see on the slide here, almost an 80% increase in the high yield market. And you can see the chart on the right, the spread levels are almost at historic lows. So a lot of that is driven by sponsor LBO activity, and that market is extremely strong and extremely well functioning. And I talked about this a little bit already, but this kind of gives you a spectrum in terms of the options available to strategic buyers. On the far left-hand side of the page are the most inexpensive options, but they are the most restrictive. So that would be ABL and pro rata financing options. The investor base for this are going to be traditional commercial banks. This is typically a 5-year piece of paper. There is going to be some amortization associated on the pro rata side, somewhere between 5 to 20%, depending on the structure. And there are going to be covenants associated with this, but you can also go smaller from a size perspective. As we move to the right-hand side of the page, those are going to be the term loan B, high yield, and private debt options. Those are going to give you an opportunity to raise more leverage, so move farther out from a debt to EBITDA perspective. There are some size limitations in the term loan B and high yield market. We have on the page, 250 on the term loan B side and 300 million on the high yield side. But really what I would say is, to really get appropriate execution, you have to be at the $400 million size or above. But those debt options are very, very flexible in terms of very limited covenants, very little amortization. And you can obviously see there, you can push leverage, and those are really used typically in the context of an acquisition, and really give companies an opportunity to go after transaction. A lot of these are going to be done in these are deals that aren't held by traditional commercial banks. So someone like Wells Fargo would underwrite companies into the term loan B and high yield market. And the last thing I'll mention is these do require ratings. So companies will have to put together a rating agency presentation and get the deal rated, which obviously facilitates the execution. That's the end of the section. I have another polling question. Ben, before I step off, if there's questions, I can obviously address those. And we can talk about any of the different markets that we talked about. We don't have to limit to the debt side.
Yeah, I think that's great, Chris. Really appreciate it. So, and just as an FYI, I know there's a lot of data on these decks, and we are going to share the deck with the broader group. I think the Cordia team will and Jerry Becker team will get that out today or tomorrow. But the one question that did kind of pop up, and I know we don't do this exactly, but any sort of expectation for 2025 and beyond in terms of, it was a very broad question, but like similar to 2024, improve from an M&A and ability to capital, find debt, or kind of more restrictive? Any thoughts on that?
So a couple of things I would say, and we'll get to the political discussion in a minute. The regulatory environment may change depending on the administration, which would certainly facilitate M&A. Tim talked about some potential rate cuts, and I think as interest rates decline, we feel like that would drive M&A volume in 25, and then we expect the equity markets to be very strong as well, which should facilitate increased deal volume in 25 as well. So look, we think the environment's going to be great. We also think that folks are kind of waiting, as I mentioned previously, for the election to kind of us to get through the election cycle. So we think there's a bunch of folks that are kind of waiting to launch processes until we get a little more clarity there. So we think Q1 and Q2 specifically in 25 will be very busy from an M&A perspective.
Gotcha. Chris, that's perfect segue into the final kind of piece. Really appreciate your time, especially since you're on the road. And obviously great information. And like I said, we'll share the slides this afternoon or tomorrow. So thanks
so
for
much.
joining.
Yep.
Yeah. So kind of to round out this morning's session, we've got something that we thought would be kind of obviously very timely and kind of very interesting. Within Wells Fargo's government relations group, we've got a couple of folks they're going to kind of walk us through some of our expectations through the next, 6 days or something like that. So my colleagues, Nida Zaman and John Hand are on the phone with us, or excuse me, on the call with us, and they'll walk us through kind of, like I said, the way we're seeing things. There's kind of some banking stuff in there, which may be helpful again for the way you and your companies are thinking about 2025 and beyond. But with that, I'll turn it over to you guys and we'll get the slides up and we'll get rolling here.
Sure. Hi, everyone. Nida Zaman. I lobby Senate Democrats for Wells Fargo. And here's my colleague, John.
Yeah, John Hand with Wells Fargo. I handle Republicans in the House of Representatives. So anyway, excited to be here.
Yeah, we're going to just walk through a couple slides on the election and talk about the Senate and the House and the presidential, and then answer any questions you all may have. So I'll start with this Senate really quickly. Democrats currently control the Senate 51-49, but it's a really tough map for them next week. Two seats would knock them out of power. Joe Manchin of West Virginia decided not to run again, so Democrats have essentially surrendered the West Virginia seat to Republicans because the state is heavily red, and I think Trump won it 65-68% in 2020. At the start of the cycle, Democrats were looking at really tough races in Nevada, Arizona, Michigan, and Ohio. But at the moment, the Democratic incumbents are running ahead of Republicans in those states. And this brings us to Montana. Both parties are focused on Montana. This is the tipping point race, which will decide the control of the Senate. Montana is currently represented by John Tester, and he's been the senator since 2007. He is a farmer and has like a really unique brand, but Montana has become increasingly red, particularly since COVID and from folks moving in from the West Coast. And so Republicans have recruited Tim Sheehy, a veteran and a businessman, and he's actually running 7 or 8 points ahead. And this means very likely on Tuesday that the Senate will flip to Republican. And so that would mean at least a 51-49. They could potentially pick up Ohio, but I think most of us think that Ohio will remain with Sherrod Brown. What does this mean for the Senate? Well, anything in the Senate to get done needs 60 votes. And so any legislation that moves forward will have to be bipartisan. And that's what the scenario is right now with the small lead that the Democrats have. Nothing really moves the Senate unless there is bipartisan agreement. So that's the Senate. I'm going to hand it over to John to talk about the House.
Yeah, thank you, Nida. The House, kind of similar to most everything else in this election, looks to be really close. Republicans have a small House majority right now, but Democrats would only need to net a pickup of 4 seats out of 435 to reclaim the House majority. I tend to think that the environment favors Democrats in the House a little bit right now. Republicans are defending 18 congressional seats that are in districts President Biden won. So those candidates have a little bit of an uphill battle. Democrats are only defending 5 seats in congressional districts won by President Trump. Another reason I'd say that Democrats have a little bit of an advantage is they are winning the fundraising game big time over Republicans right now in House races. So I know some of these incumbent House Republicans are struggling to keep up on the money side, to keep up running ads and digital outreach and things of that nature. But all things even, it does look to be really close. Another just dynamic going on in the House these days is the number of competitive or toss-up seats has really gone down in recent years because of redistricting. I think there's about 25 or 26 seats that are considered toss-up. this election cycle. Again, out of 435, that's really not that many. But that said, and I don't want to step on Nida's kind of presidential stuff, which she's going to go into in a second. But Trump is polling better today than he did at any point in 2016 or 2020. If that polling is accurate, that will help. I think it will help Republicans, House Republicans, to be competitive and have a chance at keeping the majority or growing the majority. But all in all, conventional wisdom says that the House will go the direction of the presidential election. That hasn't it hasn't been since the 1800s that the House has gone in the opposite direction of the president, of who wins the presidential. So that's one thing to keep in mind. And the House has not flipped. If you can think of any time the House of Representatives has flipped, a lot of people will think of like 1994. Newt Gingrich, and 2006, Nancy Pelosi. Those were a midterm elections. So the House has not flipped during a presidential election since 1952. So just one thing to keep in mind. But all in all, we'll be very close.
Yeah, very, very close. Really quickly, we'll talk about some of the committees that we work with at Wells Fargo. Most financial services committees, or most financial services companies, really focus on Senate Banking and the House Financial Services Committee. Those two committees, if we could just go to the next slide, right? Those two committees, this is a little bit about who would be running them. On the Senate side, it would be Sherrod Brown, who's in a really tough fight in Ohio for his seat, and Tim Scott. If Sherrod Brown wins his race, he would be probably ranking member, so the top Democrat, and Tim Scott would be chairman. Tim Scott put out a press release a couple months ago saying he wants to be chairman, but there's been a lot of rumors that he would join a Trump administration.
Yeah, Tim Scott would, I think, prioritize things like housing, and he's got kind of an economy opportunity agenda, trying to empower kind of the lower and middle class. On the Republican side in the House, if they were to keep the majority, I think you'd see a lot of trying to roll back some of the rules that have come out of the Biden administration, regulators over the past 4 years. I think that would be a big agenda. And I think crypto on both sides could be
Right.
They've really elevated their place in the debate during this election season. That said, I think Congress has a lot to do in terms of understanding and getting its arms around that industry. But they've certainly kind of elevated their place in the debate. Yeah.
And then the potential leadership for the House Financial Services Committee would be.
Yeah, it could be Annie Barr from Kentucky or French Hill from Arkansas. Obviously, they have very similar kind of pro banking, favor deregulation kind of approach to legislating. And Maxine Waters has been chair in the past. She is I don't know, Nid, if you want to talk about.
Yeah, I mean, she'll be in her 80s, but also put out a press release saying that she expects to be the next chairwoman of the committee. So she is, said very clearly she plans to run the committee if the Democrats take control.
Yeah, would favor consumer protection.
Yeah, and I think
Hey,
go ahead.
I apologize. I didn't mean to interrupt. I know you're getting ready to go to the kind of quote main event, but one quick question. If you had to handicap a surprise that you could see happening from kind of what you've talked about to date on the Senate and congressional side, the House, either of you want to try and take a stab at a surprise that may occur?
Sure. I think the big surprise would be if the Republicans had the trifecta. So the presidency, the Senate, and the House. That would be a big surprise. No one really thinks that will happen, but I think what John was saying, that Trump could pull up. If Trump wins, he could pull up some of these House races because split tickets are less common than they used to be. What do you think?
Yeah, no, it's gonna be very, very close. And in fact, to step on a point I was trying to make earlier, I think so much of this stuff is so close, and we could be proven wrong. And the polling has underestimated the Trump vote in both in 2016 and 2020, but honestly, nothing would totally surprise me. I wouldn't be shocked if Trump wins, but Democrats took the House, which would, to my last point, be breaking precedent a little bit. But I think that's like the $1 million question. It comes down to how accurate is this polling? It was off in 2016, off in 2020. The pollsters have been working hard to improve their methodologies. Is it accurate? Are they still counting the Trump vote, or did they are they perhaps over counting it? We'll have to wait and see.
Yeah, and we can talk about the presidency next. I think most people at this point know that the path to the presidency is through the 7 swing states. And so that's Pennsylvania, Michigan, Wisconsin, North Carolina, Georgia, Arizona, and Nevada. The conventional wisdom has been that Harris is leading in Pennsylvania, in Michigan, perhaps Wisconsin. Trump is leading in Georgia, Arizona. Most people think that Trump would take North Carolina. Polls are really showing that all these 7 states are extremely close. Whoever wins Pennsylvania, it's most likely they win the presidency because there's so many electoral votes in Pennsylvania. So, if Harris won Pennsylvania, it would be kind of bizarre if she didn't win the presidency, but like Trump would have to win a number of other states. So I don't want to make a prediction. I'll say that Harris has, she raised $1 billion in 3 months. She has a very, very organized ground game, an army of volunteers. The Trump campaign kind of outsourced the ground game to Elon Musk and whatever that organization is. So, but Trump is polling very close to Harris. Some of these states, like 1 or 2 points. I think generally we say, 1 or 2 either way just means it's in a dead heat. So we'll know more in 6 days. Anything on the presidential?
Yeah, no, the polling's been pretty stable. I think more so than in years past. It's tightened, I think, a little bit. Mm-hmm. It just shows that it's likely going to be very, very close. Trump has consistently led on which candidate would better handle immigration and the economy, which I think are the 2 top issues for the electorate. Kamala has consistently pulled much higher on abortion. It's a big issue for her campaign, obviously Democrats, and there's a lot of ballot measures in different states. I think to help, there's a handful on abortion to help juice turnout for the Democrat base. So.
Yeah, and I think at Wells Fargo, as a lobbyist, as one of the Democratic lobbyists, I'll hear from senators, the economy is doing well. Voters tell us the economy is doing well, but we also hear that voters think that Trump will lower prices in the grocery store. So these are sort of the issues that are, what we hear about in DC in our day-to-day work. But I think we could probably go to questions if there are any.
Yeah, I mean, there was a couple that were kind of answered by themselves. So to say, misunderstanding some of the midterm and the switching of the House and during the presidential election, et cetera. So, and then that, I think, to your point, toss up whatever word you want to use. It's hard to predict a surprise when nobody has a clear understanding of, it seems pretty 50-50. So, but no, this is super helpful. If anyone on the call does have follow-up questions, happy to field those via email or what have you. So, and my colleagues are, super willing to kind of chime in with whatever commentary they may need to. But really appreciate you all making time. We did, John and Nita were super helpful. We kind of put this together a little bit last minute, like in the last week. So I'm just super thankful that you all were able to kind of jump in last minute and give such really great content right before such, an important election. So thank you very much both for joining us. Yeah, with that, I appreciate everyone joining us today. Wells Fargo, as I mentioned, always thrilled to provide content. If there's any additional content we can provide, we'd be happy to do so. Just feel free to email me if you haven't already. But Grant, with that, I'll turn it back over to you.
All right, great. Thanks very much, Ben. And as usual, a very topical, interesting presentation across the board. And want to thank Tim, Chris, Nita, and John for the great presentation today. The election, very topical, just a few days out from the big election. So really appreciate that. And for everyone attending, we really appreciate you spending your morning with us again today. I'd also like to thank our exceptional marketing support team at Cherry Bekaert, including Amanda Kiefer, Maddie Robbins, Leah Gearhart, Ziba Farha, Kate Dharma, and Eunice Arias for preparing and running today's event. Couldn't do it without them, and they do a great job. Very active throughout the entire presentation. So thank you very much. Our next event, which will be the final in this year's 2024 FEF series, will be how AI and digital networks will shape the future of accounting as presented by Sage. So finally, I'd like to thank all of our sponsors for their support of the FEF series, and especially Wells Fargo for their great program today. So thanks, everyone, and we look forward to seeing you next Thursday. Take care.